We're going to bring in our next guest, the esteemed non-executive chairman of Morgan Stanley and the former chief global economist at the investment bank, Stephen Roach, joins us on the program today. Stephen, Mr. Roach, it's been a while. Thank you so much for your time. I hope you're well since you've moved back to the U.S. What do you think about the U.S. economy? Because I think at the end of August, you said you are still in a double dip camp. What about now?
Well, first of all, Susan, I am well, but I do miss you. And nevertheless, the U.S. economy, despite that, is in a very sluggish, anemic recovery. And when you have a sluggish recovery, you don't have a cushion that enables an economy to withstand a shock. So if we get a shock that's bad enough, there'll be a relapse, and you can call it whatever you want, double dip or a new recession. But in my view of the U.S., with the American consumer largely on ice for the next several years, we're going to be having this so-called double dip debate on again and off again. So if we avoid it this time, don't think that you've heard the last of this argument.
Well, I miss you, Mr. Roach, and I'm sure investors are missing the extra stimulus coming from the U.S. government these days. We just had the statement coming from the FOMC hinting to more quantitative easing. But is this really the right call right now to print more money and to fuse the economy with more debt and cash?
Well, first of all, the Fed is not done anything. They have hinted at the possibility, should things deteriorate, but you have to ask yourself, is this going to work? We've been in a period of essentially zero interest rates now for close to 2 years. The Fed has used up all of its traditional medicine and is now going to non-traditional medicine with a good deal less firepower than the conventional interest rate adjustments. And just like the fiscal medicine doesn't seem to be working a lot, the monetary medicine doesn't either, and for good reason. American consumers, 70% of the U.S. GDP, don't want to spend, and they have to pay down their debt and rebuild their savings. These are perfectly rational responses in the aftermath of the binge that prevailed in the decade before this crisis.
And what about Thomas Hoenig, the Kansas City Fed president? He says that we shouldn't be keeping interest rates at basically zero for much longer. And it looks like deflation is affecting the U.S. economy. It sounds like the Fed is in between a rock and a hard place right now. That's a nice analogy for what's happening there.
Well, look, there's a debate. Certainly zero interest rates in perpetuity is not exactly a great recipe for any economy. We're, in many respects, rerunning the movie that was played out in the aftermath of the bursting of the equity bubble, which, of course, led to property bubbles, credit bubbles, and the Great Crisis. The Fed doesn't really have a creative script to get us out of this quagmire, and this is very problematic and very reminiscent, by the way, of exactly what Japan went through in the aftermath of the bursting of its equity and property bubbles at the end of the 1980s.
Mm-hmm. And Stephen, what about the departure of Larry Summers? Some are reading this as another, I guess, indication that maybe the Economic Council for the Obama administration hasn't done its job in terms of helping the economy come out of this recession.
No, I wouldn't take it that way at all. I have enormous respect for Larry Summers, a smart man with very deep analytical skills and perspective, and yet, as smart as Larry is, this is a very, very difficult puzzle to solve, and there are no easy answers. Turnover is normal when you work 24 hours a day, 7 days a week, in jobs like Larry Summers had, and this happens with every administration, and it should not be read as a verdict one way or another on the state of the U.S. economy or the state of U.S. policy making.
Okay, but we're only 2 years into this administration, Stephen, so I guess they're working really hard. But it looks like the only member left of the original Obama economic team is U.S. Treasury Secretary Tim Geithner. You don't read anything into the last man standing out of all the names that started off with Obama?
Well, Tim's younger. He's in better shape. And maybe Larry will get a personal trainer and he'll come back again. I mean, that was his second stint in Washington. Don't forget, he was Treasury Secretary as well in the Clinton administration, and I suspect we haven't seen the end of him. But Geithner's in terrific shape.
I'm sure he's pretty happy with those statements coming from you, Steve. What about Geithner and his shape and his energy? Because he needs it to tackle with China right now, especially all the calls coming from U.S. politicians saying, what can you do to make China move on its currency regime? Tim Geithner saying he's losing patience right now, and Obama says that China hasn't done enough on its appreciation. Your thoughts on this?
Well, Susan, this is a political issue, and both Obama and Geithner are caught in the politics of the upcoming midterm election with an extraordinarily, historically high unemployment rate. But the currency issue itself is a bogus issue. It's not going to create jobs for America. The dollar, for example, is down over 22% since early 2002. And the last time I checked, America still has a jobs problem, a real wage problem, and massive trade deficits, not just with China, but with 90 countries around the world. The currency doesn't fix these problems. We've got to export our way back into prosperity, and China can be very helpful there as our third largest export market.
Okay, but U.S. politicians are saying that any change in the yuan will bring these manufacturing jobs back to the United States. And as you know, we're in the midst of these midterm elections taking place, a lot of primaries, and of course politicians want to look good to their constituents. Do you think then that we'll have the Treasury being forced next month to label China as a currency manipulator, and how big of a mistake will that be?
Look, it's a close call, but U.S. politicians have been bamboozled by a lot of high pedigreed economists to believe that the currency is the problem for middle class America. But unfortunately, that's bad economics driving bad policy. You look at what the currency prescription did, for example, to Japan. We beat up on Japan to revalue the yen in the latter half of the 1980s. They did it. They listened to us, and the yen more than doubled in value. But Japan's trade surplus, its current account surplus, barely budged. They've given the same recipe for the U.S. dollar. I just gave you the numbers. The dollar's down a lot, but the trade deficit has barely budged. The currency is a foil for politicians who don't want to accept responsibility for what they've done to mess up the U.S. economy.
Okay, but Tim Geithner has argued before that there is some manipulation coming from China, saying that the Chinese government has had to continue to intervene in the exchange market on a very substantial scale to limit the appreciation of the RMB. When people look at that sort of maneuvering, do you think they have a case then for maybe slapping these trade sanctions on China and Chinese-made goods?
No, I think they don't. China has elected to maintain a fairly tight relationship between its currency, the renminbi, and the world's reserve currency, the U.S. dollar. But if you look at China's currency against all the currencies that it trades with around the world, it's been rising steadily, albeit not at a rapid pace, over the past 5 years. China, like most developing economies with embryonic financial systems, needs an anchor in a sea of financial instability, and it's chosen to tightly manage its currency to produce that stability. Financial stability is something that's lacking in the developed world. We could actually learn a lesson from China.
Okay, Mr. Roach, always a pleasure. Hopefully I'll see you back here in the Asia Pac soon. Thank you for that.
You'll see
Stephen
me,
Roach,
Susan.
the non-executive chairman of Morgan Stanley.